Good morning, everybody. My name is Samuel. I'm CEO of Bonart. Let me welcome you at this event. All you distinguished guests, we have some developers, investors, media today here. I will carry on in English as we have dear international guests for the panel. They are some of them in the audience and some of them online, so they are in the background listening. We will start with about 15 to 20 minutes presentation to provide some food for thoughts and the panel, and we will follow with the distinguished panel of international investors that are already involved in rented residential to provide their international view. So before I go to slides, let me start with a story. Back in October 2013, about 10 years ago, I was sitting in Amsterdam with a bunch of people, developers, investors, and a deputy of mayor, contemplating about rented residential. And it was pretty much the same situation as now. The asset class was not known to the city hall, to the banks, to developers or investors at the time. It was pre-election time, so everybody wanted to educate themselves a little bit more so that the next period can be more involved in rented resi. And then 10 years afterwards, there are billions invested in rented resi now. We have a lot of projects that we worked on there, and there is still a huge scarcity of the rented beds. And young people are protesting on the streets that they cannot find accommodation. So this asset class is really at the very beginning here, and that's why we as Bonart, as a professional advisor for this rented resi asset class, with a global presence, and by the way, coming from Slovakia, decided to take it in a professional fashion and provide a decent platform for educating the audience, creating a networking platform, and provide guidance through the international view or optic of the investors that we work with. So rented resi is, or renting in general is a trend. So everything is moving from buying to renting, be it scooters, furniture, beds, etc. So that's only one vector of direction. And we will probably see more and more renting beds everywhere, including here, as we see already this trend in the world. The other thing about rented resi is that it's a very suitable asset class for Slovakia and Bratislava itself. Some of you are our clients, some of you we have had the conversations already. We concluded that the other asset classes are sort of reaching its roof, be it office or retail. So there is not so much to grow, and there is a time for diversification. So this asset class also offers a very good segue. The other thing is that we see from the macro perspective that it's good to be spread to other asset classes, especially so-called defensive counter-cyclical asset classes like the rented resi is. So in time of economic downturns, renting is on a upward swing and provides to both the developers and investors a good way to be securing the bottom line. Also, rented residential now is providing the returns that our investors and developers were used to in other more mature asset classes. So you can now sell for more than 4,000 euro per square meter, either to individual investor or to the institutional investor. So it is nearing the feasibility from economic point of view as well. And lastly, rented resi is also in a public objective. So the public authorities, being the city or state, have their strategic interest to support this asset class, which means that there are probably a few factors and influencers to look at the asset class a little bit closer. So let me dive deeper into slides. So a bit about us so that you know what perspective I'm gonna take. Uh, we are professional data research and advisory firm focused on rented residential, originally headquarters in Vienna, now spread globally in Canada, Australia, Asia, Europe, etc. And after about 15 years of doing business everywhere else, we started doing business in Slovakia as well. Um, and we have advised more than 600 clients and projects. So we have a lot of experience in hands and in-house. We advise more than 10 billion of uh, sort of investments. Uh, we, mo we monitor 253 cities and almost 14,000 assets. So we have a lot of data in-house, and therefore a lot of investors are turning to us for the guidance, advice, and avoiding mistakes. About 15% of our business, 1/5, is in CE, so it's a marginal part of our business, but we are more active now as the asset class is arriving, and there is more and more business for everybody. We have a team of 56 people in Europe. 8 of them are today here, so feel free to talk to them after the session. Over here, you can see some of the investors that we work with, among which are Morgan Stanley, Goldman Sachs, AIG, TPG, Patron Capital, etc. So the big heavyweights, out of the top 400 investors in the world, 123 are already involved in rented residential, and about 50% of them we already work with. So we have a good connections to the investment base. Uh, we just need to somehow bring the Bratislava a bit more on the focus. These are the trends for renting. So how many people buy beds and how many people rent beds? In Slovakia, it's only in between 7 to 8% rent, while European average is 30%. And in Czech Republic, as the closest neighbor in terms of the customer behavior, it's 22%. And as I mentioned, it's very unlikely that this trend would not arrive to Slovakia and that there would not be more people rather renting or than buying. We don't believe that this will be as far as in Switzerland or Germany, that it's almost 50-50 rent and buy. But even if 5% more people rent than buy, we would be talking about dozens of thousands of beds that are needed in rented resi to be built. What is rented resi or so-called build to rent? So build to rent is, on an institutional size is usually 300 units and more, uh, owned by an institutional or private equity investor, so one owner, managed by professional operator, and with services downstairs for the tenants that they have in-house. So that's usually considered as build-to-rent product. So not small things, not run itself, and not without services. So it has to have 300 plus. It has to have one owner, professional operator, and services to be in-house in the house. Within build to rent or rented residential, we have few subclasses based on the what kind of tenant is there, what kind of location is there, or what kind of length of contract is there. So I will not go to details now, but you will have the presentation available so that you can study it at home. But we have student housing, co-living, micro living, private rent service, then single family, multifamily, senior housing. We also do service apartments, but that's a separate chapter. So you have basically rented residential for each of the age group, from student, co-living, young adults, then and build to rent senior housing. And any of these, based on the target audience, may have different location, different size of the room, different price tag on a rent. So what build to rent is and what it is not. Build to rent is modern studios and apartments built specifically for renting. It's about long-term renting establishments, so not 1 or 2 weeks or months. It's usually 1 year and more. Professionally managed and well-maintained public spaces in-house. What BTR is not is affordable housing, social housing, only for young people, or private apartments, so that the single flat sharing market. That's not built to rent. The typical characteristics of the sector is that it's part of the multifamily or the private rented sector. It's a proven concept coming from the United States. Multifamily represents 40% of overall investments in real estate in the US. Over here is less than 1%. In Europe is less than 17%. So still a way to go, as we know that the European market, not always fully, but in certain degree follows the US market. In US is already 25 years history. Basically the other features that I mentioned over here, I already discussed. Next one over here, it's an example of student housing. So purpose-built student accommodation, that's the shortcut. Just to show you, and also when you have it at home or for the media, that, for example, this sub-asset class has matured so much that you already have segmentations like in hotels. So 3-star, 4-star, 5-star. So affordable, upscale, premium product. See some facilities over there, and you can click on a virtual tour so that you can see the asset from inside. But it's a very advanced product, very advanced asset class that has not arrived to the particular market of Bratislava. But sooner or later, it will be in this scale. The other thing is that the investors from abroad are well educated how the proper student housing, co-living, built to rent should look like. So when you start working with investors from abroad, they will be a very good counterpart to work with because they are already quite sophisticated. On the other hand, they have very specific expectations. So they would probably need your product to fit what their institutional criteria are. And often in Poland or Bulgaria, when we do this product, the local developers need to be first educated what is the right type of a product to be delivered for investors. Here are some examples. I will just quickly run through them. This is in Wembley. If you go to London, I strongly recommend to visit it. It's a 5,020 flats for renting, built on Wembley by McLaren, one of our clients. Flats from 20 to 50 square meters for about 35 to 50 pounds per square meter per month. That's the signature product. The rents are different, but if you have a chance to see the product, I strongly recommend as a good case study. Next one is from the region, Resi for Rent from Poland. Very good platform run by one of our clients. They've done thousands of beds, very institutional, 200, 300 and more beds. They are, most of them, except of the one, fully let before opening. So it's a very successful product, 28 to 35 square meters rooms, and they charge from 600 to 1,200 euro a month. So the rent levels are already quite good. Another one from Budapest. These are bigger apartments, pardon me, for 36 square meters and more, from 500 and more. And we also have a dear Balin from Budapest today, so he can tell us more. He himself has 420 beds in Budapest, fully let, so he can share his experience. Then we have Prague, again from the region, Peter Noak, Zeitgeist. So he has few houses in Prague and Poland, so expanding to Poland now. He's very successful. He's sort of on a sort of 3-star, 4-star level, so very sort of straightforward vanilla product that is hitting the affordable level. His charges, however, in some central locations are very high. So normally he rents 500, 700 euro, but in the central Prague, as you can see, it's 1,000 to 1,200 euro per room per month. Then we have student housing in Wroclaw, a very good project, former bakery retrofit by Basecamp, over 700 rooms, so big building to fit, to rent with tenants. But he's running at the average of 620 euro, and he has no challenge to fill the premises. Another one, Libinex in Krakow, 700 beds, around 600 to 700 euro per room. We're talking about 18 to 20 square meters. So it's a very good revenue per square meter from this rented resi product. Another one, our client in Prague, so Trigema, they built Fragment. You probably know that product. Help them with some other projects as well. It's a huge success because not only they are fully let before at the time of opening, but they rented it for much more than the underwriting was done for. So the market showed very strong, and with the dynamic pricing, that as you are nearing the full occupancy, you can increase the rents. So they were able to really rent it for high levels. A few last examples, Domek from CTP. This is what we done together with Raymond in 7 months, I have to say. So fully constructed. And it's 300 beds, something more than 250 rooms, 623 euro average rent per room, close to downtown, fully let all since 2017 across COVID. So it's a huge success as it was done properly. And then fees in Prague. So this is co-living / student housing, 675 rooms. So again, big institutional product built by Carlin Group, then taken over by Brookfield. It's 740 euro rent per 18 square meters rooms. And again, it's fully let. It's not a challenge to let it. It's a challenge to get the sizable plot in these cities like Prague or Bratislava. The indicators. So we issue every day news about what's going on in rented residential in the entire world, all the transactions, pipeline, applications, refusals, regulations. So if you wish, be it media, developers, investors, you can sign up. It's for free. We deliver it to entire world. So if you want, you can have access to daily news on rented residential. The total transactions are 20 billion euro a year in Europe. So you can have an insight on what kind of investors invest in this asset class. So just to go to economic factors. Rented residential is about to grow because of the three main reasons. First, it's a shortage of the stock, so there's not so much to rent in as much as it is the demand for renting growing. Second, the mortgage perspective, so not so many people can buy, or less and less people can buy, and more people need to rent, especially when they are mobile, so they don't want to fix. The marriages are 5.3 years later. The mortgages are taken 5.1 years later than the previous generation. So there is new 5 years window for mobile citizens of Europe to rent. And then sort of demographic trends. So basically, this is the mobility that I just mentioned. Over here, you have some CE examples from investors across the CE. You see the blank white country over there, right? So we don't have much of institutional investments. Uh, Colleagues from Lucron done something, so they are here. They can say later on. But on an institutional side, so 300 plus, such a rented res investments is not has not been done yet, and it's just a matter of time when it arrives over here. But it's not as far as France or Netherlands. It's in the neighboring countries. Here are some investors that we work with in rented resi. So you can see AXA, Patricia, Moda, or KKR, Apache, Harrison, Amro. So big names, GIC. They are very familiar. They have billions in rented resi. As I had the conversation with probably half of you here, the capital is not a challenge in this asset class. It's much more to find sizable plot or project to invest in. And Slovakia has a big advantage to Poland, Czechia or Hungary, Eurozone country. So investors would love to invest in Euro countries, especially in these days, but they don't have a sizable project big enough for their capital. When we show them 20, 30 million projects, they are not even look at it. So it has to be really something north of that, so that they look at it with certainly sufficient returns. Banks are quite familiar with the product as well. So we work with Erste or Raiffeisen or Santander, HSBC, Barclays, which we had here in Bratislava recently. So for them, it's asset class as any other. Their donor here in Slovakia probably need to educate themselves a little more, but it's a matter of time. We did the same process in Netherlands, in France, in Poland. So that's not a problem. It's just a challenge to. So few last slides. We're arriving to Bratislava. So Bratislava has about close to 500,000 citizens, as we know, in American mobile computers. The population is slightly growing, while the foreign population is growing faster. And the foreign population needs rented bed. They don't necessarily buy. So the potential for rented sector is great. We did a primary survey over several thousands of people here in the streets of Bratislava to find out where they live, where they want to live, how much they pay, how much they would be willing to pay for an institutional product. And we learned that Bratislava is one of the top 10 investable cities in Europe in terms of the metrics. So it just needs a product. Now about the cycle, this might be a bit shocker to you, because I know already from the conversations we had how normally the international investors in Western Europe or in Poland have an investment cycle. So they stepped in after the zoning permit. So they usually don't get involved before zoning. So the zoning needs to be there, and your product needs to be prepared in line with their expectations by the time. They entered the conversations at the time of building permit, so that there is no more than 3 years time to market, so to opening. So that's when the conversation with you, with potential operator of the asset, with the banks. By the time the permit is concluded, there is a capital commitment on a forward funding or forward purchase deal or a JV. Different structures. But then the asset is opened, usually occupied in year one, not at the opening, but in year one. Fully let at the opening is a mistake, because you probably let it for too cheap. So it's usually the bank provides a 6 months holiday so that the operator has proper time to rent the asset for as high rent as possible. Once the building is fully let, then we have renewals. About 35% of the renters renew after a year, and you can increase the rents again because you don't have so much need for new tenants, as well as you decrease the marketing costs, which means that you open the NOI, which is usually about 65 to 80%, depends on the type of and size of the asset. So when you open the NOI and the yield compress in those 5 years, usually about 150 bips, then you exit. So this is the standard model, less applicable here or in Italy, where things take time. So it's a bit challenge because the IRR is diluted. So therefore, usually the exit will need to be sooner than that after 2 years, so that the IRR is good enough for the investors that basically in general expect the high IRRs here, uh, higher IRR here than in Germany. I'm not sure what you could hear because it's breaking up a bit. Sorry. So that shows also the life cycle of investments in rented resi. So usually the entry is here, low royalty, 7% yield, no product. Uh, By the time exit, you basically arrive to sub 5 yield. When the capital in living sectors is compressing the yield down, and you exit. When we started student housing in France in 2011 with one gentleman, he was distributing about a 1 billion euro. He was building at 30,000 euro per unit, which is 18 square meters studio. And in 2016, he was exiting at 130,000 euro per unit. Obviously, he's retired now, but that's the story you can do on a young market. And that's what the investors are looking at. Some of the indicators here for the reference so that you know where is OPEX, NOI, cap rate, IRRs, expectations. I will not go through all of them. I will just say that basically about 18 square meters unit is expected to be delivered at 75 to 100,000 euro. So you can do your math on square meters, price per square meter. Initial development yield is expected to be north of 6%. OPEX is usually 23%. So with additional property tax, operator's fee, you are arriving about total cost of 35%. So the NOI is 65 or more if more efficient on OPEX. Sinking fund, so maintenance fund is usually 1 to 3%, 3.5%. The reserve fund for capex. Operators' fees are usually 5 to 7%. NOI average 67. Cap rate. In Poland, we are now around 6%. Before September 22, we were at 5.25, 5.5. So the yields extracted a little bit after September 22, but it is expected that if you have portfolio premium or size premium or master lease premium, you can reach a little bit more south towards closer 5 yield already in these times. The IR expectations are north of 15% in this region, which is achievable as the LTVs for this asset class are around 50, 55% on a development loan, and then the sort of operational loan is probably a little bit sweeter. So I hope this has provided some initial thoughts. Thank you. And we can probably move to the panel. First of all, I would really like to thank our dear panelists to share their time and knowledge with us. We have Anna from Invesco from Warsaw here. Welcome, Anna. I will give you an opportunity to introduce yourself then. We have Ernestus for 1IM. So 1IM investment group from Lithuania, but they are building portfolio across Baltics and CE. So they already have assets all across. They also been here in Bratislava. So they like it and look at this as an investable destination. Then we have Joao from Solida Capital that is basically developing and managing developments all across Poland as well as Portugal, Brazil, and other destinations. So it's a bigger group that is basically very involved in rented residential. He is talking to us from Warsaw today. And we have Balint over here from Forest State Group, We have a very long-term relationship. We have seen his assets several times. He's probably the most experienced here professionally in a rented resi. So thank you for coming from Budapest and sharing the time and experience. And we have Dusan, who we work with here in Bratislava. Many of you know him, and he's sort of helping us to be more present at the Bratislava and Slovakia market. So now, ladies and gentlemen, let me kindly ask you to, in about 30 seconds, to introduce yourself. So Anna, can I ask you to start, please?
Yes, of course. My name is Anna Scheltz, and I'm representing Invesco Real Estate, US origin investment manager. Currently in Europe, we have around 15 billion AUM, and it's spread over 13 countries that we are managing from 8 offices in different markets. And it's different asset classes with different investors, different funds. We are having our own open-ended funds. We are managing separate accounts for mainly German funds. So we have different pockets of money, different investment strategies. Therefore, we have core assets that we keep for a long-term hold, but we also do some developments with our opportunistic money that are high return strategies. And all over Europe, we are involved in different PRS projects, still not in the CE, or rather not in Poland, because we are having our first resi project in Prague together with Zeitgeist that Samuel has mentioned before. So it's almost completed, and it's gonna be launched soon. And we are actively looking into Poland as we are focusing on Czech Republic and Poland when it comes to CE.
Ernestas, may I ask?
Hello, everyone. I'm Ernestas Kasparas. Nice to meet you there. I'm representing one asset management and investment company located in Lithuania. We are licensed fund management company. At the moment, we are managing the Central Eastern European Student Housing Fund, which is trying to develop a 5,000 to 6,000 portfolio beds across the CEE countries. Currently, we have operational assets in the Baltic states, Latvia, Lithuania. Then we have one operational asset in Poland and actively developing. And as well, we are looking for possibilities to do PBSA projects in Slovakia and Czech Republic. And we believe that this asset class is really now up to date, and that this is one of the best times now to step into this asset class and invest. Thank you.
Thank you. João?
Well, good morning, everyone. I'm João Saracho, representing Solida Capital. So we are both, I would say, investor and developer in this sector. But mainly we operate as a local partner to some platforms active in the region. So basically our mission, it's more to identify investment opportunities in the PBSA and co-living area. And then we actively work on partnerships or other models of cooperation to bring live these projects, and we use our own local resources to operate and to execute these projects. So basically, this is in a nutshell where we are focused. We are focused mainly in Poland, nevertheless scouting as well Czech and Romanian market for possibilities.
Thank you. Balin, please.
Samuel, my name is Balin Botos from Forster Group. We are a Hungarian developer focusing on Budapest mainly, and focusing on hospitality projects. We have a 400-room PBSA, as Samuel just mentioned, and now Marriott is on the development. The group is focusing from construction to the operation. I think we can bring up the value, we can create more value in this holistic approach. And especially interesting for you is our PBSA project, which is Dean's College Hotel. with 480 rooms, and it's a hybrid operation model. So it's also have student accommodation rooms and the hotel rooms, and then these rooms are changing dynamically year long. So in the summer it's mostly a hotel, year long is mostly a students. So it's very interesting to manage. It's a pretty success project, I can say, but although it's the only one in Budapest, so the market is still developing.
Thank you, Dusan.
Good morning. My name is Dusan Tarchak. I've been in the real estate market for more than 17 years already, working mostly as a project manager on various projects in Bratislava for developers. Sorry, it wasn't working probably. Right now I'm working as an individual advisor for various developers and focusing mostly right now on the rented residential. And we just started a partnership with Bonart here on the Slovak market, so helping them to access the market and to bring this asset class to this Bratislava and Slovakia market.
Okay, I start with the obvious question. Why have you entered rented resi? What is so enticing? I remember some of the conversations with you 5, 6, 7 years ago, like with Balin in Interconti in Budapest 2014. And we put a plan on the back of an envelope, and then he did 400 bets. So what is so attractive? If you shortly can tell us, all of you, why you entered this asset class. Balin, you can start.
Yeah, that time this was exactly 10 years ago, I think in the beginning 2013. And the market was pretty similar as it today. So office was not pretty compelling. Residential market is not exactly the same as residential rental market. So many people are changing these two categories and they are putting in the same basket, but it's totally different. So residential for sale, office, commercial building, other commercial buildings like hotel and halls, shopping malls, they were not attractive enough. And the demand was obviously there in Budapest. It was a hidden demand, so we couldn't find, or it was hard to explain for other investors, co-investors and banks why you want to ask from the students in that time 300-400 euro per room, although they could get in the state-owned student accommodation on the student halls for 100 euro, for 50 euros. So asking the 6 times higher price, why does it make sense? Because it's scarce. So there was no supply. The demand was already there, but it was a hidden demand. So the market was pretty compelling, and it's a niche sector. So the large developers who are focusing on office building, they are changing the mind hardly to focusing to student accommodation or rented resi. That's what I felt in 2013. The math was good and the niche sectors, that's why we started.
João, your decision?
Yeah, happy to make my input here. Look, I think that I can say that we were kind of we did the first steps in Poland. Besides student deposit, I think this was the number one move. The main reason was, well, I relate to a lot what Balin has said, because it was exactly same rationale of not really good opportunities in other commercial real estate, such as retail or offices. As you know, in Poland, it was a really big boom with a lot of heavy competition from international groups such as Galemco, Eco Investments, other big developers in that area. So it didn't offer a lot of space to enter the market. And on top, I think what we were looking back then when we started to think about this was in 2019, 2018, was we wanted more of a niche market, a market that was clearly growing on Western Europe. So we could see basically through the years or through the timeline what was happening in countries like France, in Spain, and in other countries, and somehow predict what was going to happen with that asset class in Poland, although there are some differences. And what is happening globally now in CE, I would say that not even in the best predictions we could see the market developing so fast. But I would say as the main let's say goal or trigger was some lack of opportunities, plus all the fundamentals that now we see about the short supply of residential, of population going out of the city center, students having to be recalled back into the city center. So these are all important factors that we see as a big contribution for us to operate in this asset class.
Thank you, Anna. We work with Invesco in London and Western Europe investments, but you represent Invesco in CE. Why have you decided to invest in the Zeitgeist in Prague? What was so attractive? We cannot hear you. Anna, you need to turn on.
Right. Prague is a very specific market with a very limited supply due to the very long permitting process. So we believed it was a one and only opportunity to acquire from Crestil, together with Zeitgeist as an asset manager here, this project that, you know, we over the first 12 months, the prices comparing to our acquisition price have gone up by 20-30%. And we believe in PRS and residential sector as an asset class. Yes, we all know there is a huge demand, especially in CEE, that has a strong supply gap from post-communist times. So we see also the tendency changing, that people in CEE are no longer so interested in buying and owning their apartments, but they are more open for renting it. They are more mobile, they want to have flexibility, and this is what PRS has to offer. So I'm not sure if we will ever be on the German level of almost 60% apartments let, not owned, but I think we still have a huge gap to catch up with the rest of Europe, and it's coming. We also see the internal migration. Recently, there is the external migration of people from Ukraine to Poland, also to Czech Republic. The cities are growing, and this product will definitely be in demand.
Thank you. Ernestos, maybe I shift a bit of a question now. You are very experienced in different geographies, early to the asset class geographies, like Lithuania or Poland, working with city halls and banks. And we have Bratislava representatives here. We have few banks here. So can you share the experience? Sometimes Spain, I know you gone through Citadel and others. So can you tell us how was the process? Did you need to educate them? Was it difficult? What were the painkillers, etc.?
Yeah, so with regards to the city halls, I think it was quite again easy work, because like in Poland and the Baltic states, we don't have like very long processes to getting the building permit and everything like that. So it was quite okay, and there was not a big problems. Of course, they kind of needed some time to understand what we're going to do there, because there've been some cases in the market that someone is like developing something called like a hotel or hostel or a student housing, and then, you know, dividing into different units, and, you know, at the end of the day, selling, let's say, to the private individuals. So we needed some time to prove that we're not going to do that way. That is going to be like real student accommodation with a professional operator, and that pretty much there is no intention to sell and to do like everyone else did. So I think we spent some time on that, because there were like lots of questions. But in Poland, in the Baltic states, as I said, the processes to get the building permit are quite easy, and you can get it up to 12 months if the master plan and zoning is in the right let's say, right position. Regarding the banks, so of course it was much longer process, I would say, and pretty much they didn't know how to treat it, whether they treat it as like a hotel financing, whether they should treat it as like a resi to rent. So it took some time, and you know, at the beginning you don't get like very favorable conditions for financing, so you need to inject, I think, more equity and less debt, which maybe doesn't make the investment case that attractive as you would like to see it. But then later on, like when you have in some of the assets, let's say we have third or fourth operational season, and when the banks see that there is a stable cash flow, even if you have like lots of different small tenants, they kind of trust it, and then the conditions become to get better, and then you can get a refinancing or additional debt to refinance your injected equity. So I think this is in a process. I know that Slovakian market and the Czech market, they're different what in regards like the regulation and the permitting. But I think the markets already as well are more educated, and they already see some projects as existing.
If I may be more specific, and I ask the same question to Balint, what are the sort of for you, Ernestos and Balint, the time periods that you need to spend with the bank, and how many sort of offers you usually receive, and what kind of LTVs you are reaching, if you can share? Ernestos?
Yes, so pretty much, okay, when we do the project in our home market, which is the Baltic states, so the processes are quite faster, I would say. But when we go to another markets, for example, Poland, so we are treated as foreign investor, and then we do the bank financing on the LMA standard. So typically it takes, I would say, 6 sometimes to 8 months from first meeting with the banker and introducing the investment case until signing the agreement. In the home market, when we do it like at home, it could be 3-4 months maybe, but I would say that you need to count like 6 to 8 months. When you do the development, when you're at development phase, because we do the development, so I think maximum what you can expect like 50% LTC, like 50% from the cost, including the land, including the financing costs, like pretty much all the costs you experience during the construction. And then when you are operational, I think you need to generate the 12 months EBITDA cash flow, and then you can do the debt sizing on a generated cash flow, pretty much reaching 20-25% the 20-25 years repayment schedule. And then the debt sizing is done to have like debt service cover ratio, I think 1.2. Typically you end up 60% LTV to match to 20-25 years repayment schedule and 1.2 debt service cover ratio.
Balint?
Yeah, I think bank is one of the challenging point of the student housing and the BTR market. As it's a stable asset class, so the yield are a bit lower than an office building and a hotel building. So the DSCR, what you have to cover is DSCR 1.2, 1.3, what you have to show up. From the less cash flow, yearly cash flow, it's harder to get out and harder to produce. So because of that reason, probably you arrive to a 50% LTV or LTC in a development. Even though if you are just, especially in Hungary, the national bank, who is the authority of the banks, have some special rules which are not existing in Austria, for example. So independent how much LTV you are financing a project, so it can be a 40 or 60%, you must amortize 4 or 5% of the debt yearly. So amortizing 4 or 5% of the debt, and you have to pay the interest on it. So altogether, you are paying currently a 9% from the debt yearly, and if it's just a 40% LTV, it's 4% yield basically. So you're not even covering the 1.2. So when we do a tender in Hungary for student housing, as we did last year for the refinancing of the construction loan to an operation loan or a long-term loan, we involved Austrian investors, Austria financing companies, the banks, also, as they don't have this amortization rule. So they just must to cover the interest with the DSCR, not the interest or amortization, because there was no amortization of 40-50% LTV. So it's challenging. It's a bit different in an office building or for a hotel building. Of course, you don't have the solid benchmarks. The Hungarian student housing or the BTR, it's just a very, very tiny niche market. So what you have shown, the BART project is basically the only one in Budapest for a BTR project. You can't show other, and it's not even fully filling the 300 rooms because it's just 240 rooms. So altogether, I think in BTR it's just 1,000 rooms, 100, and the 250 rooms what you were just mentioned. So it's challenging to convince the bank on the benchmark side. It's challenging to convince the banks on to apply kind of bit different rules for the BTR and student housing than normally they do for office building and other financing. But you can do. So basically we had 3-4 offers for the refinancing of our student house.
Dusan, if I can ask another inspirational, provocating question. So we spent about 4 months now in Bratislava talking to developers, to the city, to the Schwerbe. So, and we cannot find a big plot enough to invest. Do you think that the land bank here and the zones over here will somehow allow any kind of a suitable institutional product? Because that seems to be a challenge, the size of the product and length of the permitting.
Yes, we had several meetings with the developers mostly and the banks in the Slovak and Bratislava market especially. We are experiencing that the suitable size of the project and the land it's very limited, right, in Bratislava. But of course, there is a huge potential regarding the new master plan which is being created right now and or updated. We see a huge potential in the brownfields, which there is a lot of them in Bratislava, especially, and in the bigger cities in regions as well. And we have to mention that as you're all experiencing, the market right now is down, right? The curve is going down. The residential products, the build to sell residential apartments are now slowing down the sales, and the rented residential is a very good question, answer to this question, what to do right now, how to continue with the developments of the most residential developers. As we had these meetings and discussions, we can all agree on that this is probably the way how to solve this, I would say, complicated times that are waiting for us regarding the developments and the construction. So yes, that's why we started the cooperation, right, on the Slovak market, that there we see the huge potential that there is, I'm not saying a lot of them, but at least 1,500 beds could be developed within the next 10 years, right? So it's just what 5% gain on the market for the.
I think the Bratislava can easily swallow 3,000 to 5,000 beds by 2030. Immediately, probably 1,500. It's 10 o'clock. I know we was announced to be concluding at 10, but we started about 10 minutes later. So we will probably expand the time for our panelists for about 15 minutes. So Anna, if I may ask you as an investor working with local PRS, BTR, student housing, sort of GPs and developers, what makes a good partner for you? You know, who would you partner with? And what kind of project would you opt for in the geographies that you invest?
So first of all, what I will refer to the previous panelist, it's the size. Yes, that often is a problem. We have a certain minimum volumes that we would expect. Normally, when it comes to other asset classes, our general minimum size is 30 million euros. In case of PRS, we are able to go down to 20-25 million, but still sometimes it's difficult to achieve. Also from operational level, we would focus on the projects of 150 to 200 apartments, but we know it's difficult to find them, so we are also looking into smaller projects. Regarding the partner, again, this is the new market. I think we're all somehow learning. So it would be great to have a partner with a long track record of PRS projects or BTR projects, but there are not many. So we're just focusing on developers with some track record. And obviously, we are also looking for partners for operators, because we are not assuming to create our own platform. This is something that is not in our strategy. We are not planning to have a very sizable portfolio of PRS in Poland. It's rather scattered all over the Europe to diversify the risks. So we would rather use external operators, and this is again something that is growing. There are companies that are appearing, but a lot of the current players are doing those things in-house. Also, this is the problem from the FIFA perspective. We know that PRS is counter-cyclical, very safe, but not very profitable product, especially with the current hedging challenges and financing challenges. So we believe in the asset class, in the product, but the numbers are still very, very challenging. Yes, and we need to have a reliable partner, as we are open to enter JVs or to forward acquisitions. So we don't need to have a ready standing project. Yes, we can commit to the future.
It seems like the sourcing of the affordable land is the key. Maybe in this regard, Joao, if you can share with us, you did the project in Gdańsk, or more than 700 beds over there for student depot and Resi4Rent. You did in Krakow, youth building in Warsaw now, you're preparing projects in Wrocław. So what kind of returns you work with when it comes to initial development yield or IRR for investors? Just give us interval so that you don't give up your secrets, but just some kind of an idea so the crowd may have a sense of the return temperature.
Okay, you go straight to the point. Maybe let me put it this way. Obviously, there were some challenges over the past year. So some of the projects like those in Gdańsk or comparing to the recent projects, the numbers are quite different because of construction costs, land costs, etc. But I would say that we are in a period of definitely the costs are in a stabilization trend. So it's easier to predict a little bit what's going to be the development yields or entry yields for the investors. And accounting on a normal model of a forward purchase, like Anna was mentioning, or where you have green or brownfield investment, I would say that you could expect entry yields around somewhere around 7%, maybe a little bit higher depending on location. Maybe if you go to very prime locations, you will have a little bit lower than that. But then you also have security or higher rents will not be competing on price. I would say that this asset class is very interesting on how it behaves on yields, because the historical data and the current transactions on yields are quite interesting. I think it was one of the asset classes that was less affected by that. So if you look at offices, logistics, there was a huge growth in yield. I would say that here the yield was maintained at very healthy levels, which means that you can expect interesting compression over the next years, especially looking what are the prospects for the market. I would say only one more thing is that you can expect to find models in which a developer will fix the price. There are also models in which that's not exactly the like a forward funding or a forward purchase model. But definitely in terms of IRRs, depending on the model, at least what we target to have on the table and to deliver to our partners, it's somewhere around an 18 to 20%, sometimes higher. But this is, I would say, the average returns that you could go for on the current market scenario, and with a perspective of exit into 4 or 5 years. So this is I would say this would be my take on what we see now going forward.
Thank you. I would touch on the construction side of the equation now, and maybe you can share with us, are you using GCs? Do you do construction management, build by design, or what?
Okay, I think I heard the question, so maybe I'll try to guess what's coming next.
Okay,
But
go ahead.
yeah. So basically, our model relies on the fact that we engage with experienced GCs, so GCs with a high track record on residential hotels area, which is very similar to the PBSA model or to PRS model. So just to give you an example, the last GC contract we have signed, and one of the sites we are building in Warsaw, which is a 420 rooms scheme next to the old town. It's being built by Skanska. So we usually use the model in which we are supervising the GC. We make all the design on our side, and then we are supervising we engage with the GC and supervising. We think this is the right model. Project management can achieve some savings. So if you do packaging, we are not very keen on that model, and that's why we prefer to invest on strategic relations with key GC companies in the market.
Ernestos, your experience here?
As we can step in quite early, let's say, in the project, so acquire the land, but even without the building permit. So we typically engage with a experienced project manager who helps us, during the licensing process if the building permit needs to be obtained. Typically, when we obtain the building permit, then our project manager with whom we work, they help to arrange a tender, where we typically ask for a GC to provide a fixed price contract. And this was possible to get all the time. Okay, there were some periods where I think the GCs didn't want to work on a fixed price contract. They were looking for open book contracts. But I think now in the market you can really get it, and typically ask for a 10% plus bond, let's say, for the fixed price contract from the GC, that it would be secured. That's what typically the banks are looking, because typically when you do the development projects, so they want to know a security on a budget, that there will be no cost overruns. So we work actually with the biggest GCs in the country. We typically use a project manager who helps us, with the licensing and arranging all the process to get a GC contract, and then later on, the project manager is supervising the GC whether they are on the budget, on time, and of course for the banks we typically as well hire external technical supervision, where they kind of come to the site and check the progress of the construction, and sign off every invoice you send to the bank, for a loan disbursement.
Thank you. Balin, your model,
It's better to work with the GC. It's easier. But as Ernesto just mentioned, in the recent year, the fluctuation of the raw materials and the labor force and everything was so hectic that some GCs wanted to choose an open book. We are rather opting, as we have a pretty strong project management team in house, so we are rather opting for packaging up the GCs work, so 3, 4, 5 packages, and it's still fine for most of the banks. So we can manage with the banks. There's no difference, not a huge difference compared to a GC. But open book, probably bank financing would be hard to accept by the bank.
And Dusan, how does this model fit to Slovak context?
I would say that in Slovakia, most of the developers, they kind of use either the general contracting or maybe the construction management, depends on the type of the project. But I would say that for this region, it would be probably it would make sense to do the design and build process for the building, even if it's construction management or the general contracting, just because I would say it's very similar to the hotels and the residential product. You have to deal with fit outs, you have to deal with all kind of details, which is, I think, smart to place this risk on the general contractor mostly.
Before I go to my last question for all of the panelists, I just probably mentioned that most of the rented resi is built under hotel permit because these are short-term leases. So it's closest to hotel and therefore it's a commercial asset. But some of the assets, like in Germany, are under the residential permit, but the tax regulation is different then. And you need to be ready to deal with VAT. This is another thing. So my last question before the time expires, probably for all of you, from what you heard from the presentation, what you learned about Slovakia, and comparing to your experience, what would you recommend to this market to do as a next step, going through the very initial stage of rented resi development? What kind of mistake to avoid, or what kind of things to amplify? So maybe if we can start with Anna, tell me.
Well, it's a very unregulated market, and it has some pros and cons. When we compare it to Spain, to Germany, we have a lot more limitations regarding the length of the lease terms, regarding the potential rental increases. So this is somehow against the investor. On the other hand, we always like to have some kind of security, and I think it's kind of challenging that still those regulations are appearing, are changing. We had some changes regarding the amortization, I think like 18 months ago, that impacted the returns. So obviously it would be great if it would remain quite open and profitable in terms without the caps on the rental increases, but still somehow regulated market. For the moment, we are rather looking into the commercial zoning, but this is more because of the lack of product in the regular resi to sell, as the sales are still booming. So we are open to do projects on a commercial zoning, and we have initially studied the tax regime for that, and we're fine for that.
Thank you. That's your message. Ernestas, can I ask you?
Sorry. Yeah, so pretty much as a Slovakian market, or especially Bratislava, it's quite hard with the permitting, and there is not so many opportunities to step in with a bigger project. We haven't experienced it yet, but I would say that pretty much like we should focus on retrofitting some of the, I don't know, existing assets or changing the use of it. So I would really hope that city councils and all the regulators would be kind of like helping in that process, that they would be flexible, and that these conversions could be done. So I think this is like from the city hall maybe as well. You know, for a banking sector, I think it would be great if most probably in Slovak market there is a lot of international banks who can look how their partnering banks, they're financing projects in their home countries, and maybe they can bring that experience to Slovakian market and then be prepared for that.
Thank you, João.
I would say in very short lines, mistakes to avoid. In my perspective, I always sit on the side of being in better locations, even if it's a bit more expensive, rather than compromising on location. This is number one mistake that I see happening on a first wave of development. Definitely, I believe that those projects that were built on more suburban areas or not so nice areas due to costs, they will struggle in the future for pricing. So this is definitely a mistake I see in the market sometimes, and I think it's maybe harder to work on a business model with a bit higher costs, but not compromising on location. Second, I think it's very important, and I think it's an area that doesn't have a big focus, but as the market is growing, especially in Poland, is becoming a bit more sophisticated. It's important to think how the assets are aging. Okay. The assets, I see now some assets that were developed back in 2017, 18, 19, and these assets today already are at certain age level that should be less than what their 5 years operation are. So in my opinion, I would recommend that there is a strong thought during the conceptual stage to how the projects should age, what kind of services you will offer inside of the project, as the amenities is a keystone, both for PBSA, both for PRS. I think that the direction of the market is definitely going with offering something else than just a residential unit to the tenants. And I would say that these two factors, it's really to give it some longer thought and avoid. The third, and I would say also key for the performance of the assets, is the operation. I think it's very important that you are well sustained with a great team on the operation. I'm more keen to say that should more and more it makes sense on these local markets like Poland, Slovakia, Czech Republic, to have local resources that understand well how the leasing should be done on the market. So I would again invest on internal resources and build an internal operator.
Thank you. Balint?
Yeah, so the market fundamentals are pretty strong, and I think the supply demand gap will be even larger in the following years. So the fundamentals will be even better in the following years. So the Central European region is absolutely undersupplied. The demand is there and is coming with the onshoring and all of the global trends. I can give you two suggestions to deal with these challenges that we just mentioned. I think one, which was Joao was also mentioning, to bring an operator into the project as soon as possible. So operator is key, especially in the PBSA sector. BTR is also important, but BTR, it's a bit less operation intensive. BTR it's a must to have a good operator. We changed our operator. We had a third-party operator for the first 2 years, and we changed them after 2 years because we have seen that it won't go on that way. So it can't go on that way. We doubled the EBITDA in 2 years. We doubled the EBITDA with the new operator. And the second one is to bring institutional investor, co-investor into the team as soon as possible, who has access to the end cheap money, who will send for the end asset. So it's a German pension fund, it's a German insurance company. So somewhere who is the end buyer of the project, because I think that these are the large owners who will buy on the end, but it's good to have their commitments as soon as possible. So you will have a faster track record and faster speed on the development cycle.
Thank you. And Dusan?
I'm just adding to all of these suggestions that just has been said that when entering the new market as Bratislava is, I would put a huge focus on location, because when opening the new residential product, I would say that the new investors should be very picky on the location and maybe to focus on the downtown locations regarding all the possibilities that there are outside. So and as was said, operator, and to have it designed the proper way. So have a good advising to know how to fit the standards and the proper sizes of the rooms, the proper supply and everything. So, but I don't want to repeat everything that was just said.
Great. Thank you, ladies and gentlemen. Thank you for sharing the time and knowledge. And I would probably conclude the panel. I hope this was somehow useful as a beginning of a conversation in Bratislava on rented residential and build to rent. I think the data and views of international investors were somehow useful. I would encourage you to network after the event, either to Balint or to other people. If you have more need for data or investors connections, then please let us know. We are happy to help. And I hope we're gonna see each other on a similar event soon. Thank you.